Hello, everybody. Welcome to AHA Real Estate Exam Prep. I am your webinar host, Brian Lee, hoping that you are doing fantastic, hoping that you are knocking out that state exam. Maybe you're just watching this because you missed me, that you've already watched all the other webinars, you've done all the other stuff, and you're like, you know what? I kind of miss Brian. Okay, yeah, probably not. But still, hopefully you're knocking that out. If not, I know it takes a few times for a few people, or for many people, actually. It is a tough exam, so hopefully the information you're getting in this is getting you further to that finish line, that maybe you missed 10 the last time and now you only missed 5. So we're really honing it in and giving you just more information. So that's what we're all about, is trying to help you get that information to be able to knock out the state exam. So tonight, another shallow dive, and that's almost dangerous. I shouldn't say shallow dive because, you know, the warnings in the pool are never dive into the shallow end. So let's not take a dive. Let's just do like a casual, like easing into the into the shallow water, if you will, talking about PMI and MIP, just some of the differences, where you might see them, and just a few nuances to it. Not a lot in here, and honestly, you probably won't see a lot of this on the state exam, but I'd just like to cover a couple of things to make sure that you know it, because again, I have a strong feeling and just been doing this for so long and helping so many students with this, and just getting feedback from you guys, that there are some pieces in here. There's little nuances, little things that even these small, short webinar type of programs help you to understand some of it. So tonight we're talking about PMI and MIP. So again, in previous episodes, we've talked about PMI. PMI stands for Private Mortgage Insurance. MIP stands for Mortgage Insurance Premium. They are both essentially the same thing. They do have different coverages. They do have a few differences, again, that I'll cover here in a moment. But they both serve the same purpose, and that is that they help to insure the lender. This is an insurance program that effectively, that if you are borrowing money and you don't have the down payment, or you don't have the requirements that the bank asks for, or would prefer rather, they will sometimes ask you to purchase what's called a mortgage insurance premium product, or a private mortgage insurance premium type of product. And again, this insurance is not homeowners insurance. They're going to want that too, but this is mortgage insurance of some sort, and this insurance program covers the lender. So again, let's say that you borrow $100,000 from the bank to buy a property, and they go through the foreclosure process. You haven't made payments, and they sell the home for $90,000. So the bank has taken a $10,000 loss. Well, if you have this insurance premium, this mortgage insurance policy for the bank, then the bank would file a claim against that insurance policy and say, hey, the borrower that you insured didn't pay us off. They owe us money still. We sold the home. We lost money. Insurance policy, pay us off. Kind of just like if you were to get into a car accident and you have $10,000 of damage, the insurance company will likely, hopefully, pay off that, or pay that $10,000 to fix your car. So that's what PMI and MIP are. They're similar in that way. PMI, though, private mortgage insurance, is for, or exclusively for, private type loans. So we're not talking about public or governmental loans. So anytime you see PMI, you'll have to know and remember that we're talking about a private mortgage, something that is what's also known as a conventional mortgage. So conventional mortgages typically recognize that if you have if you have 20% down payment, that you're going to borrow 80% or less. So what we're saying here is that your down payment is at least 20% or more. If it's more, then that's even better. But if it's at least 20%, or rather, you are borrowing 80% or lower in that situation, then you don't need any PMI. If, however, that your down payment is less than 20%, it's 19%, 15%, 10%, 5%, whatever, that means that your LTV is going to be higher than 80%. So it's going to be 89%, 85, 90, whatever it might be. So in that case, we're looking at what's called an insured conventional mortgage that requires PMI. So that's what this is. PMI, I don't know that you'll see this, but I just always like to cover it real quickly, can be expressed a couple of ways. Most of the time, it's going to be a monthly type of premium that you pay this mortgage, or you pay this PMI, this mortgage insurance, on a monthly basis. So it's included in your monthly payments that is made by the borrower. So that's something else that's worthy of note, that it's a monthly type of program. There are, on occasion, something called a one-time premium. So instead of paying it monthly, you can pay it all up front at once, and usually the lender will give you a discount. So just making up a number, let's say that if you couldn't afford a one-time lump sum payment, that you pay $5,000 over a few years for insurance. But if you do have some money, the lender says, instead of paying us $5,000, why don't you pay us $4,000 up front? So it becomes a savings to you that you can pay us $5,000 in monthly increments over time, and you will have paid us the $5,000. Or you can make a one-time payment of $4,000, and we'll just take that. So it saves you some money. So that's an option. A third option that we see on occasion is what's called a rate bump or a rate increase. So they would say that based upon your credit and all that, your interest rate might be 4%. If you don't want to pay PMI, if you don't want to get into that insured conventional situation, we'll bump your rate up to 4.5%, 5%, something like that. We'll make it a higher rate, which effectively pays for that PMI. So those are a couple ways you see this. The last thing I want to address on PMI specifically is that there is something that the federal government put out in 1998 called the HPA, the Homeowners Protection Act. HPA, Homeowners Protection Act. What this says is that when your equity gets to 22%, which means that your LTV is now at 78%, and if your payments have been made on time, PMI must automatically be taken off by the lender. So the lender cannot continue to charge you PMI indefinitely. That again, if you've made your payments on time and you've paid down the debt so that way you only owe 78%, which is an odd number. Don't ask me where they got it from. I'm sure some legislator thought that was the brilliant number. Regardless, when your LTV is 78% or your equity is 22%, then PMI has to be taken off. The only other thing I have to add to the conversation is with regard to MIP. So I mentioned at the beginning, MIP is mortgage insurance premium. Again, it's the same thing as PMI. It serves the same purpose, but MIP is specific to FHA type loans and USDA loans too. So these are both governmentally insured loans. This is not a government loan. It is a governmentally insured loan. So the bank is making the loan just like they would with any traditional mortgage. But in this case, FHA or USDA is insuring it. They insure it because you as a borrower are paying MIP or making mortgage insurance payments. FHA has a kind of a unique thing. I had mentioned with PMI that you have the option in some cases to do a monthly or one-time payment. With FHA, they don't give you that option. You have both. So it's not even like you could pick one of the other, or that you get one or the other. They charge both. They charge what's called an upfront MIP. So you're going to pay an upfront premium, and then you're also going to pay a monthly premium. So you're going to pay both of these. So you don't get the choice. It is all done. The last thing about MIP that a lot of people really, really enjoy is that MIP does not drop off once your LTV gets to a certain number. So you could owe the bank $5,000 on $1 million property. And if it's an FHA loan, then you would still be paying MIP on it. So again, most people would say, okay, I'm gonna get rid of my FHA loan. But regardless of that, it's important to know that with an FHA loan mortgage insurance premium, the MIP does not go away once your LTV, even when it drops to below 78% like it did for PMI. So let's go through a couple questions to make sure we're on track. The first question, well, shoot, I just said this. Per the Homeowners Protection Act, HPA, PMI is required to be removed if the borrower is on time with their payments and their equity is equal to or greater than what? So remember, there's a couple of percentages. A lot of people, well, I'm just going to let you go. for a minute. What do you think here? What do you think the answer is when their equity gets to here? Because make sure you're reading these questions. So because we talked about all these percentages tonight in this webinar. We talked about 78%, we talked about 22%, we talked about 80%, and we talked about 20%. So what do you think the magic number here is to make the PMI go away? What does your equity have to hit? Anyone? I know there's some latency here. Well, let's work through this. The 80-20 portion of this has nothing to do with removal of PMI. 80-20 has to do with the creation of the loan. That when you are, or rather when you are first taking out this loan, if you have 20% down, then they will not charge you PMI. So you get out of PMI altogether. So C and D are not the answer. C and D would be the answer if you're starting the loan. If we're taking out the loan brand new and you have 20% to put down, then they don't charge PMI. But the question is saying that you have PMI, meaning that you didn't have 20% down. So maybe you only had 15%, whatever it might be. So you didn't have that. So C and D cannot be part of this. If the question said you're taking out a brand new loan, then we'd probably be looking at C and D. But the HPA, the Homeowners Protection Act, is saying that you have PMI, so now we're looking at A and B. But remember, we're looking at what the question asks, and it says when your equity is equal to what number? So unfortunately, Ashley, Darla, and Greg, with love and respect, you're all incorrect because it's not 80-20, but it's also not 78%. 78% is the balance of the mortgage, but the equity that you have is 22%. So the HPA says that once your equity gets to 22%, or when the loan to value is 78%, then the PMI goes away. So in this case, the equity, which is what the question is asking, is 22%. If it asked what the LTV was, then Ashley, you would be correct. Then it'd be 78%. If it said that this is a brand new loan, does not have PMI on it yet because we're making it, then we'd be looking at C and D, because then at that point we're starting the loan, I have 20% down, or I'm borrowing 80% only, then I don't have PMI at all. So make sure you keep that straight. So this was a great question to go through to help demonstrate that for you guys. All right, next question. This was one that was a callback from the other night. So again, for those of you that have watched the previous webinars, some of this is rehash. For those of you that have not watched one of these webinars, this is brand new to you. But we did talk about VA loans a little bit tonight, so that was where this was relevant, is that which of the following loans is guaranteed against a loss by government? And I'm just going to give you the answer because we've already been through this. I do recommend that you go back through our webinars and find the ones where we did talk about FHA and VA loans. But the only one that guarantees loans, the only agency that guarantees loans is VA. They're the ones that guarantee loans. So we didn't talk about that tonight, but we did talk about VA, so I did bring it up in here, but we'll move on. Next question. All the following are advantages of FHA insured loans. Again, this is another question that we talked about the other night, and I'm just going to kind of skip through it real quickly because it's pretty straightforward as well. That this is the one where FHA does not provide any buyer protection. We talked about this earlier too, that MIP that's included, that mortgage insurance premium, covers the lender. It does not give the buyer any protection at all. So that's why I brought it up into this webinar as well, is that there's no protection for the buyer for that FHA insurance. The insurance is the answer D. It protects the lender. So that would be an advantage for the lender, but this is not an advantage for the buyer because the buyer gets no protection at all. FHA and VA loans are similar in all the following aspects except what? What do you think? FHA and VA loans are similar in all except what? Do they have loan down payment requirements? Both include a mortgage insurance premium. Both of them have more relaxed loan approval requirements. Or D, the government protects lender against loss with either insurance or guarantee. So what the question is saying is that they're similar in all the ways except. So which of the ways are they not similar in? There was one that we talked about tonight that we got into. So which of the following is not a way that they're similar. Both of them have low down payment requirements. It's one of the benefits of having them. We talked about that in the last webinar of LTV, is that the bank has low down payment. Or, I'm sorry, the loans have low down payment. C, they're both more relaxed. They both are more relaxed. They allow higher credit scores, stuff like that. So you're good there. The government protects lenders against loss with either insurance or the guarantee. They are similar in that way. FHA is insurance. VA is a guarantee. So the only one that makes sense here is B. VA loans does not have MIP. They do not. There's no insurance premium at all for VA. VA lenders do not have, or VA loans do not have any insurance premium. So FHA does have MIP, but VA does not. So I see a lot of you typing in D. D is not the answer. FHA provides insurance, VA provides a guarantee. So they are similar in that the government has protections for the lender. Both of them have that feature. What they don't share in common is that FHA has MIP, VA does not have it at all. So the answer is B here, guys. All right. So hopefully that helps you a little bit, making sure that you're keeping that straight in your head, because there's a lot of pieces. Again, I don't know how deep of a dive you'll see or how much of that you will see on the state exam, but it's always worthy of note on what those are. So there were a couple of good questions in there to kind of help really put it in your head on what that means. So make sure you keep those straight. Watch plenty of our webinars. Be sure to please subscribe to our channel. We'd love to have you guys watching these videos, helping you get through your state exam. If I can help you, you can find us at ahareep.com. Hit us up. Use our resources. We are here to help you guys. Take care and have a legendary night.